Hi, my name is David Weinstein, and I call myself an Airbnb CPA. And I've nicknamed a part of my website the simple short-term rental cash flow forecast, which is simple but very useful to Airbnb clientele, so I'm told. And this is the companion video to my simple income cash flow forecast workbook. So let's just dive right in and begin. To paraphrase Benjamin Franklin, those that fail to plan to fail, which is I'm very passionate about. Any type of person that, is going to put significant parts of their wealth into something like an Airbnb should do their homework. Now, you shouldn't have paralysis by analysis, which means going through figures for years on time, but you should get a decent understanding of the investment property, the geography that you're putting it in. And there's lots of places you can get this information. Let's just say for starters, you can go to Zillow or Redfin and get what properties have been appreciating price wise. The second place is Airbnb or VRBO itself. You can go to a property that's close by or similar to the property that you're looking at in the geography you're looking at, and type in what the guest fees are in July or September. And then you can plot those numbers in. You can go to other sites and get what Airbnb guest occupancies are going to be. There are Facebook groups and LinkedIn groups that you can go on and talk to existing Airbnb hosts, all of which are willing to give you information. So let's just dive right in. First, I just want to point out a couple quick things about the website and some of the services they provide, and we'll dive right into the workbook. Give me a second while I get my annotation so I can highlight what's important. And here we are. So this is sharingeconomycpa.com. You can download the workbook here. Just want to highlight, I give a free hour of QuickBooks, and I'm a QuickBooks expert. I have a few clients that are even on enterprise, which can handle up to 30 users and hundreds of millions of dollars in terms of a business enterprise, but most use QuickBooks Online. Also, I'm an expert in Wave Apps, which is a free service, and Stessa and Hurdler. Both are apps you can use on your phone, download from your bank, and code up your short-term rental enterprise. So if we click details here, we'll come to my forecasting page. I'm not going to repeat anything. I'm just saying there's a lot of information here for you to dive into, but basically you click this big green dot and there's lots of other places to click and you get the financial model of the workbook. It starts at the end, but you principally want to go to the input screen, which is all the way to the left. And basically there's two columns, B and D. Now, B is where you put your information. It automatically flows to the 30-year mortgage. But if you want better figures, you can simply ask a mortgage broker or go online and get figures for a 15-year mortgage and a 30-year mortgage. And you can overwrite what this workbook puts in for a 30-year mortgage. So for this example, we're going to say that our property is going to begin in March of 21. We're going to have a 3% growth rate. Now, at the time of this recording, there's a pandemic because growth rates and inflation rates are low. So in a different environment with higher rates, we'd have higher growth rates and higher inflation rates. But that's not the case at the moment. So let's just say we're in a $500,000 house. We're going to put down 20% and our rate's going to be 3%. We're going to project $50,000 a year. The mortgage comes from the amortization table, hence the financial model. We'll say that our real estate taxes are $7,500. This is something you could look up on Redfin. If there's a homeowners, if it's a condominium, there's going to be a homeowners association fee. We're assuming, to make this simple, that it's a single family rental. But if it was a condominium, the utilities and other expenses would be smaller, but there'd be a demonstrable homeowners fee. So for this, we'll just simply put $12,500. And now we have our figures. Again, One thing to mention of note, we don't have depreciation or income taxes. If we had that in the model, it would be a complex model. But if, lo and behold, if you want to have that, those calculations, you can call somebody like myself and I'd be happy to expand upon this. So it draws out, it does our calculation. Everything here is formality driven. You'll notice that there is no interest after 2036. That's because the mortgage is paid off. Also, very importantly, if you look here, this is the operating margin. And this is simply the net rental income divided by the revenues. Now, in this low rate environment, the percentages for the 15-year and the 30-year forecast are very close to one another. And that's because the rates are low. As a matter of fact, in this environment, it's beneficial to take a 30-year mortgage. Most of the time, that's not true. In a higher rate environment, it's more beneficial to take a 15-year mortgage. And the reason is very simple. There's more than likely over the life of your 30-year mortgage, there's going to be a period of high inflation. So here's the 30-year payment. Notice the payment is smaller, but you pay it for longer, and that the operating percentages are comparable to the 15-year. So here's a chart just showing that over time, if we go back, our 15-year mortgage, we have a $2,700 payment. Well, on day one, $1,000 is going to be to interest, and about $1,700 or so is going to be to principal. Principal in a 15-year mortgage always exceeds the interest, but the payment stays the same. It's just that every payment you make will successively have more principal. 30-year, the interest is greater than the principal for a period of time and then crosses. This has an effect on our model. It's all the reason why it's included. What is equity? Well, we put in $100,000, so that's our beginning equity, but the property is worth $500. What's in between is what's financing. So as financing decreases, our equity approaches what the value is. Now, the 30-year model is over a longer period, but also more slow. There's a higher slope after 15 years. This now, here's a critical date. There's a bump here in your net rent. That's because your mortgage went to zero, so you stop paying interest. In the 30-year, the slope increases when principal exceeds the mortgage. This is just now is that we're pretty much making very little in the beginning years, but notice we're above trend line in the later years. Now, this is important in terms of your business model, because what? You might be wanting to buy more properties after you've paid 10 years of the mortgage. And this is a 30-year, and here's questions. Now, folks, my phone number, the contact information here is at the bottom. But what I urge you to do is hit the schedule appointment box, and my calendar comes up, and you can make an appointment with me anytime that my calendar is open. I would be happy to meet and discuss what your issues are, free of charge. And if you become a client, you get an hour free of QuickBooks consultation, which is all that you'll need. You get a workbook, and I look forward to your success. Thank you for visiting my video, and lots of luck with my workbook. And please, by all means, give me feedback. I welcome it. And thank you very much.